Hi, I'm Joe Wright, Financial Advisor with Sage Advisors. We've all been told that owning a home is probably the best investment we'll ever make, and the recent times have actually challenged what we have been told our entire lives. So let me talk about some of the myths that we've all heard and see if they still apply today. Myth number one: we should always buy a home instead of rent. Now, this is true in most cases. However, there are certain situations where renting will make much more sense than buying. Let's say that you're going to stay in a residence for only a short amount of time. It could take a while for you to recoup the costs of buying that home in the first place. Second of all, coming up with a down payment can be a hard thing to accomplish, especially if you have to take away from your retirement savings or any other savings goals that you had in mind. Third, homes cost money, and regular maintenance and repairs can be a financial burden on most folks. So if you can't afford these regular expenses, especially property taxes as well, perhaps owning a home is not the way you want to go. Myth number two: a home is always a good investment. Now, there have been times throughout our history where this has definitely been true, where you purchase a home and the value always goes up like clockwork. However, in recent times and throughout history as well, there are certain points where the real estate market just drops, and sometimes it drops precipitously. So we also find people that find themselves in what I call the homeowner's nightmare. That is where there has been a history of increasing property prices, and people gain substantial equity in their home, and they decide to tap that equity and use it to fund other endeavors. And then when the market drops, they actually turn out to own less of a home than what they're paying for in their debt obligation, their mortgage, or their home, or in combination with their home equity line of credit, home equity mortgage. This is a situation that challenges our belief that a home is always a good investment. So to actually realize that a home is a good investment as time goes by, there has to be a substantial amount of time that you actually own the home so that the market price can catch back up to where it was before and eventually surpass the value that it had previously been at. Myth number three is you should always pay extra principal on your mortgage. There are some instances where I challenge this. Granted, that is a great place to put your money. You're going to be realizing a rate of return that is the interest rate that you're getting charged on your mortgage. However, if there is a possibility that you can put that same amount that you would be paying principal with into, say, your retirement accounts, hopefully as time goes by and over long time periods, you'll realize a rate of return that's much greater than the mortgage rate that you're being charged. Also think about the fact that interest paid on a mortgage is deductible, and you're not going to still receive those tax deductions the more and more you pay your principal down. Myth number four: always refinance if interest rates are lower. Definitely, a lower interest rate is going to save you money over the long time period. However, there are certain costs associated with refinancing a mortgage. And if you're not going to hold that mortgage for a long time, you're not going to recoup the costs of refinancing right away. Plus, refinancing to a longer time period, let's say you still have 20 years to pay your mortgage off and you take on a new 30-year mortgage, that's not necessarily going to have the effect that you want it to. A good barometer is lowering your mortgage payment by 10 to 15%. That's certainly going to add value to your monthly cash flow and should increase your net worth as time goes by. And finally, myth number five: using home equity loans to get out of debt in other areas. Yes, this is a great strategy because you can lower your interest rate. You have the opportunity to pay off your previous debt over longer time periods, and interest is deductible. Those are great reasons to refinance or take on a different home equity line of credit or a home mortgage. If interest rates rise and you need to refinance again, your cost of borrowing is going to increase. Next, if you take on more debt in addition to what you just refinanced, now you have more risk on your home that you didn't necessarily intend to take. So be aware of this. This can be a potential pitfall for most people. Achieving success in investing is tough for people to do on their own. Here at Sage Advisors, we've got the tools and the expertise to make that happen for you.